Hey guys, Scott Adams, the home co at Keller Williams. Just bringing you a little market update with the crazy economic cycle that we're experiencing as a country and how it is affecting the housing market. So 22 has been quite a ride so far. We started the year with 3% and change interest rates. Now mid-year we are at or slightly above 6% interest rates with more Fed interest rate hike on the board. That's probably we'll see another 0.75% hike and then a 0.5% back to back in July and August. So we can kind of extrapolate what has happened with the first set of interest rate hikes and look forward and see what that impact's going to look like. And may want to take a look at your real estate holdings. You might want to just make sure that you're properly positioned to kind of weather the storm. I don't think it's going to be a really long economic cycle, but they are definitely wanting to get inflation in check, and I think it's going to be a pretty abrupt. The tools they have are fairly blunt, using interest rates. So I think these big jumps are going to cause a pretty abrupt retraction in the demand side for housing. Now, people are always going to move. They're going to always relocate. They're always going to, upsize, downsize. People are always going to move. It's not going to stop the housing market. And this economic cycle, albeit doesn't really qualify completely as a recession so far because of the housing market is still really strong, it's going to feel like one. It's not going to be like the 2008 recessionary event that was, rooted in the housing industry and the housing mortgage-backed securities, just decimated the housing market. Not going to be anything like that. It's going to be more like the early 90s or the early 2000s recessions that we experienced then. I don't think although inflation is kind of what it was in the 70s, but I think the Fed's really going to like I said, use their blunt instruments with the interest rates and finally raise them fast enough to kind of stop the inflationary. They're going to kill the demand side to stop these, this crazy inflationary prices that we're seeing with energy, with food, with everything else. Some of the commodities are already starting to pull back. So I think it is going to be a fairly soft landing. I think it will probably take about 18 months for everything to cycle through and for kind of the world to get back to normal. And then as soon as we start seeing those interest rate cuts, we'll know it's over and they're kind of letting the economy expand again. So it's a really interesting time. Now, what does this mean for real estate? So if you are, I would say if you are looking to move in the next 3 years as your plan, you probably want to get where you're going as fast as you can. If you are considering selling any real estate assets in the next 3 years, you probably wanted those on the market a month ago. Now, what we're experiencing in the market at the beginning of the year, you put a house on the market, it was you had 40 showings in 2 days and 30 offers, and now you were still getting offers. There are agents who are still allowing their clients to price way ahead of the curve, not doing the proper preparation, because you could get away with that. But everything is changing so fast right now. You kind of bring your A game when you come to market. It's got to look great. It's got to be priced right. It's got to be well marketed. And you're not going to get 40 showings in 2 days. You're going to get showings if you have done everything properly, and then you're going to get one offer, maybe two. And what we saw earlier for the past 2 years, really, where to win a bid, the buyers had to give up everything. You couldn't do a home inspection. You had to buy it as is. You had to close. You had to let the seller live there after close. I mean, it was nuts. It was not, markets in the extremes are really not, they're not fun. Whether it was '08 and it was a huge buyer's market, or '09 huge buyer's market, all the way up until 10, 11 as well, or now when it's a huge seller's market. Those markets in the extremes are not fun. We're going to actually, you could, I guess, interpret what I'm saying as kind of doom and gloom, but it's not really. It's a great normalization. It's bringing things back to a more balanced market. It's tampering the demand side of the total economy, so that prices can just normalize and go back to seeing 2, 3, 4% inflationary pricing over time with our real estate assets. So it's really, really interesting right now. I mean, over the course of the last 2 years, any agent with a pulse could sell the house. Would they get you the best deal? Would they negotiate properly, protect your interests? I got to work with, when the market's going up, there's a lot of people that get in real estate because they think it's just, it's easy. But it's not. And who you work with, especially now, who you work with matters. So give me a call. Let's make sure we talk about your assets, your plans, moving forward, even if it's not an imminent thing. You're looking, hey, 3-5 years, I'm going to be, let's take a look at it now, just so that we can, best position your equity and your cash flow, if it's investment properties, or primary residence. So there are not going to be a lot of foreclosures coming on the market. So I've already got, I just want to find a deal. There's no foreclosure deals coming on the market. Those are usually packaged up by banks now and sold to hedge funds, who hedge funds over the course of this from 2008 until now, this last full economic cycle, we're about 40% of the total home purchases. So they, were institutional buyers and iBuyers. Zillow was in the market for a little bit. They've quickly exited when they found out their estimates were all broken, and they were losing, just hemorrhaging money. But Open Door, there's you've got, the in the Southeast area where we service in Tennessee and Georgia, South Carolina, North Carolina, and Florida, you've got the Mark Spains, you've got the Mark Heights, and these people who have just come out with low ball investor buyers, which is great. It's great. Myself and our investors can make a lot of money, but it's at the homeowner's expense. So what does this mean for you? It means, like I said, if you're planning on moving, get to where you're going as quick as you can. On Facebook the other week, I put out a little blurb that had some interesting feedback. It said marry the house and date the rate. So I would get in the house that you want to be in, even if the interest rate seems high right now. As they go up, you'll look good for getting. You'll seem smart for getting in early. As they go down, which I suspect that they will. I don't suspect we'll ever see, the 3 and 4% interest rates for a long, long time. But as they kind of moderate to where now we're actually at, kind of a 30-year trend line with interest rates. So we're pretty close. I think this will be the nominal, the par rate will end up. I think it's going to go higher before it comes down, but I think it'll probably live about where we are now. So get where you want to go, marry the house, date the rate. If the rates come down, you can refinance out and to a lower rate. If they go up, you're just going to look that much smarter for getting in now. On the buyer side, another thing that we've noticed is buyers' rights coming back. So like I was saying before, is instead of having to do no inspection and let the seller live there and after closing and the buyer's giving up everything, all of that is coming back quickly. So now we get to do inspections now. there's the sellers are having to make contributions to closing costs, or buy down, or buy down points, which is something that we're putting in a lot of our contracts. Sometimes we'll even write above asking, and then and just to get the contribution coming back to buy down the points on the interest rate, to get the points lower, to get the interest rate lower. So we've got some creative ways to best position our clients, and our home sellers are realizing the best possible net proceeds because of these negotiation strategies, and our buyers are actually getting the houses that they want and can afford it even with these higher interest rates, because of some of the buy downs that we're using on the rate to bring that monthly payment more in line with their needs. So anyhow, really interesting market. It's going to get more tumultuous before it gets back to normal. So like I said, who you work with matters. Give me a call. If you want to search all homes in the Georgia, Tennessee, South Carolina markets, you can click the button below to search all homes. If you want to get a valuation, right now the automated evaluation systems are, whether it's Zillow or Red, or mine even, all of the automated systems are, because they are all backwards looking. They look at what has happened. They don't necessarily project trend curves as to which direction that will continue to happen. So those models, those automated models, even on my website, are going to be a little bit off right now. But if you click on it, do one of the automated models, and then I'll go ahead and run you a more detailed report to let you know exactly where you stand. Right now, like I said, I suspect interest rates are going to go up in the month of July and the month of August by 0.75 and 0.5 in August. So these, if going on market something that you think you might be doing, let's start talking as soon as you can, because we need to make sure that we have our plan in order so that we don't experience any market retraction in pricing, depending on where you are, as these interest rates begin to tick up. So look forward to hearing from you. Like I said, use those links below. I'll bring you another market update here really quick, because I think the next few months and this year are going to be pretty exciting stuff, for better or worse. But anyhow, thanks for tuning in. Look forward to hearing from you, and I'll see you next time. Talk to you soon. Thanks.